On today's episode, I'm going to show some tips and tricks on how to read a balance sheet. And I'm also going to take a look and explain what are the major components or the major items I'm looking at when looking at a company's balance sheet and doing my fundamental analysis. And if you're new to my channel, you might be asking, who the heck is this guy going to talk about balance sheet? To be honest, probably for the past 2-3 years, I've looked at a balance sheet at least every other day. So I've had a bit of experience, you can say, looking at these and understanding what I'm looking at. If you are new to my channel, don't forget to hit the subscribe button. I post a lot of fundamental analysis companies. So in today's episode, what I really want to do is pretty much show what I'm looking at when I'm doing my fundamental analysis. So like always, all of this that I'm going to say is just my opinions. I am by no means a professional, so none of this should be taken as advice. Make sure to talk to a financial advisor before making any financial decisions. Now that we have that out the way, let's get started. So like I said, today's episode, I am going to be doing a quick review on the balance sheet and just some tips and tricks. If you are new to my channel, don't forget to subscribe. Don't forget to hit the thumbs up and let me know in the comments, how are you guys enjoying this? I am going to do this a series for the other financial documents that I take a look at. And hopefully my main purpose is to reduce my videos, my fundamental analysis videos, because I do repeat a lot of things, because I'm trying to explain what they mean. And I feel by doing this, I'll be able to cut back a bit on those explanations. And if people have questions, they can always come in here. So first, I do believe, so like I mentioned, this is going to be a series. I'm going to do one for the income statement. I'm also going to do one for the cash flow statement. So make sure to let me know in the comments if you guys actually learned anything from it. So I do believe, though, the first thing before taking a look at any of these documents, and I'm going to show this in all three episodes of the series, is understanding what stage your business, the business that I'm about to do a fundamental analysis, is in. Because I do believe that this determines a lot of how I view the company's balance sheet and their income statement and their cash flow. So pretty much a business has the following cycles. It has the establishment cycle, and this is when things are starting up and they're getting ready. And you can see the growth is pretty linear. At some point, that linear growth starts to increase more exponentially. This is the growth state. And me as a long-term investor and my investment style, this is usually the state in the business where I'm really focused on. There's a second stage that I'm also focused on, and we'll show you guys in a bit. But one thing to note is during this growth stage, especially when it's just coming out of establishment, the company right here might be growing its revenue super quick. But unfortunately, at some time here, it might be possible that they're not profitable. And during that time when they're not profitable, I tend to be a little more strict on the balance sheet. Right? Because it makes sense. If they're not making money right now, when I'm looking at that balance sheet, I have to take to account that they are not making money, so they need a lot of cash at hands right now compared to the debt. And one of my favorite examples is explaining it think about it as your own financial life. Let's say if I didn't have a job. At this moment, the worst thing for me would be to go out and take a lot more debt. It would suck for me to go, for example, go get a car, go get a house mortgage with me collecting no income. So that's how I look at a company growth. It's me making sure that they're being smart with their money right now while they're waiting for that money to come back in. Now, if a company is already making money, that's a different story, right? So now let's say you have a good historical money coming in, then I do believe having debt is not that bad of a deal, right? Again, think about it. I think about it in my own financial life. If I'm currently an engineer, I have good compensation, you could say. So for me, it's okay for me to take out a mortgage. It's okay for me to go take out a car loan, for say, because I have money coming in to be able to pay that huge amount of debt that I'm having, because I'm able to provide it with the amount of income coming in. So I do believe it is important to understand what stage a business is in to really understand how you should take a look at those financial documents. After that growth, they're what we call the maturity state. And the maturity state it's when pretty much the company is not growing that much. More, it's pretty much flatlining. They're still selling crazy amount of products, but they're just not seeing that growth. They kind of hit a peak. For me, maturity companies are ones that I don't really focus on. Then there's post maturity. Post maturity is, it can go three ways. The first way is a decline, and one of the perfect examples for this right now that I can think of would be GameStop. Right, so GameStop established, it became a huge name, started to grow, then it started to slow down its growth, and then when e-commerce and all that came out, it started to decline. Obviously, companies later on, doesn't mean that a decline will always end bad. It can change its route over there, but it would then change to one of these routes. So then it starts declining. The other stage is steady state. Steady state is just continuing to be in that maturity state, and it's not going anywhere. It's not seeing any form of decline. It's not seeing any form of growth. The third state is renewal, and this is when they release some form of new products and continue to see some growth. And this is the second stage where I like to invest. So for me, growth is my favorite, post maturity and renewal is my favorite. And you might be like, Jose, what's a perfect example of a post maturity renewal state? Right now, for me, the ones I can think of would be like Microsoft with their clouding. Any big company from Microsoft, Google, that have just started this whole clouding network and clouding infrastructure, they were maturing for a few. And then with these new products they're releasing, their growth has returned again. So now they're in that renewal stage. So these are two companies that I invest in. A lot of people might be, if they have seen my portfolio, they might be like, why does he have Microsoft, for example, in his portfolio if it's not a growth stock? But to me, it's more of it passed this maturity state and now it's in a post maturity within renewal. So those are two stages. All right, so we're gonna take a look at a company today and the balance sheet now that we understand these types of stages, and these stages are important, like I'm gonna mention later on. So we're going to take a look at Apple, and the best way and the best place to find a company's balance sheet is to go to their investors website. You can also go to sec.gov, or you can use any other tools to help you out. Today we're going to look at Apple, and here at Apple in their investors relations, you can just scroll down and you'll find their quarterly earnings report. They also had their annual report. If you guys don't know, the quarterly report is reported every quarter, and that's after every 3 months. And that's usually called the 10Q report. Then you have your annual report, which is reported at the fourth quarter, at the end of the fourth quarter of each year, and it pretty much covers the whole year entirely. So it's a super quarter, it's a super report, and you usually get a little more information here, and that's called the 10K report. One thing to note though is, even though they say quarterly, not all companies follow the same quarterly. It's not like a calendar quarterly. It's not, for example, the 2019 fiscal year for one company doesn't mean it starts in January and ends in December. Some companies might start their fiscal year in June and end in the next June, right? So, and end in May. So these are fiscal years and fiscal quarters. Usually quarters, they're all report earnings around the same time, but maybe one company at that day would be reporting Q2 earnings, where another company would be reporting Q3 earnings, just because it depends on where their fiscal year falls or how they have their fiscal year doing. So let's take a look at Q3's most recent 10Q report. So when you open most recent 10Q report, you get this pretty cool lengthy document. And I'm going to talk about some of these in another episode. Today, we're just going to look at the balance sheet. Here you go, and you look for part one, and you go for the financial statements. Look for the financial statements. The first one is usually the income statement and some consolation on that income statement. The second thing is the one we're here to look at, and this is the balance sheet. And let me zoom in for you guys so you guys can understand, so you guys can see a little better. So in the balance sheet, what we're pretty much seeing is two different things. It's called the assets, and assets, again, think about it in your everyday life, it's pretty much what you own. Then liabilities. Liabilities is your debt. Then you have something called shareholder equity. This is how much a shareholder truly owns. And the way to calculate shareholder equities is you will do your total assets minus your total liabilities. And if that's positive, the shareholder has positive equity. For example, let's say my house is owned at $100,000, and then I have $10,000 in cash. That means I have $110,000 in assets. And now let's say I have a $50,000 mortgage on that house. So I have $50,000 of liabilities. And let's say I also have $10,000 in credit card debt. So I have $60,000 in liabilities. I have $110,000 in assets, $60,000 in liabilities. If we subtract this two, this gives us $50,000 of equity. And that's what shareholder equity is. So now let's take a look at the assets. Both in the assets and in the liabilities, you have these, they're broken down into two segments. They're called current and non-current. Let's take a look at current assets. Current assets are assets that can be sold and liquidized within the next 12 months. Usually here you see cash or only short-term investments, inventories, money that is due with the company. So something that, some form of asset that can be liquidized or turned into money very quickly. Non-current assets are assets that might take longer than 12 months to liquidize. And this might be, for example, a home. In my example, right, in the personal, it's a home. I might have a home, but if I want to sell it, depending on how the market is doing, it might take me a long time to sell. So it's not something I can go and liquidize pretty quickly. So homes, equipments are considered non-current assets. Then you have current liabilities. Very similar to current assets, current liabilities are liabilities that are due within the next 12 months. It's debt that needs to be paid off within the next 12 months. Non-current liabilities is debt that does not have to be paid off, that needs to be paid off in 12 months or more. And that's an important thing to note, right? And we'll mention that later on. But those are pretty much the two time frames: non-current, less than 12 months, more than 12 months, or current, which is less than 12 months. All right, so let's take a look at these assets. And most of them, to your surprise, they'll probably be very easy to understand just with the name and just with the name. So the first one is cash and cash equivalents. This is pretty much just what it means: any form of cash that they have, or something that has very, very low risk that can be considered cash. So this might be, for example, a high yield savings account where there's really no risk in it and they can pull out pretty quickly. Next, we have current marketable securities. Current marketable securities might be short-term bonds that have low risk, a little bit low risk, but they have a little bit higher reward than a typical savings account. Next, you have accounts receivable. Accounts receivable is, let's say me as a business, if I sell a product to another business, usually when they build relationships, they don't bill them right away. They send the products and they say, hey, you need to pay me within the next 30 days. So accounts receivable is that money they are due by their customers, and that's money that should be coming in within less than 12 months. Next, we have inventories. Inventories, pretty self-explanatory. It's what kind of inventory they have. If they were, for example, Apple here, their inventories would include their their iMacs, their Macs, their iPhones, their watches. And inventories does not have to be complete. It can also be known as, sometimes companies divide it and say raw materials. In inventories, raw material is just the materials they need to create those products. Then you have vendors' non-trade receivables, very similar to accounts receivables. And then you have other current assets. Two things I want to mention here. First, inventories. Inventories and accounts receivable can change throughout the quarter, right? For example, most companies that sell products like Apple, their inventories and their accounts receivable tend to increase the quarter before Christmas, right? Because they're building up this inventory of all these products they're going to sell during the holidays. So normally during that time, you see a huge gain in inventory compared to pretty much the previous quarter. Very similar with accounts receivable. Usually in quarters when they're selling more to their customers, you're going to see a higher jump in accounts receivables. One thing I want to mention is when we take a look at at balance sheet, you're taking a look at that current quarter compared to the end of their last fiscal year. So right now we were quarter 3 of 2020, right? And that ended on June 27th. September 28th is the end of the fiscal year. September is the end of the fiscal year for Apple. So here we can say this is September 28th, 2019. So it was the end of their fiscal year of 2019, or you can say it was the first day of their 2020 fiscal year. So that's how they normally compare balance sheets. They take a look at how it was at the beginning on the first day that they started the year. Next, we're going to take a look at liability. Next, let's take a look at non-current assets. So marketable securities in non-current assets might be like a bond that might have 2 years, 3 years of expiration. So it has more than 12 months before it can cash out. Property, plant, and equipment, very self-explanatory. Other non-current assets, just anything else that they couldn't really fit in there. One other one that they don't mention here is goodwill. And goodwill is one I don't really take a look at. Goodwill is pretty much just a fake asset to me. The ones I normally take a look at are cash and cash equivalents, and add that with marketable securities. That kind of gives me the amount of cash they have right now. And I think in current assets, that's pretty much the only one I'm really looking at. I'm also I tend to look at inventories and accounts receivables just to see how things compare, but not really. I don't really take a look on them. To me, the most important is definitely cash and cash equivalents. In non-current assets, again, I don't really take a look at much. Maybe property and plant and equipments I take a look at just to see if maybe they're buying something new. Usually if it jumps a lot, it's because they're opening a new plant, they purchased something big, they made a new acquisition. Now let's and then that gives you a total asset. So total assets is when you add your current assets plus your non-current assets. Now let's take a look at current liabilities. Current liabilities, we have accounts payable. So accounts payable is money they owe to their providers. So very similar, it's the opposite of accounts receivable. So let's say Apple, maybe they might buy their chips from, I forget, maybe Qualcomm, I think they do, right? So when they buy their chips, Qualcomm or whoever gives them their chips, gives them a 30-day to pay the bills. That's the accounts payable that they need to pay, bills they need to pay within the next 12 months. Other current liabilities here, you might have, if they might have some form of lease on some of their buildings, you might see that here that they need to pay soon. Deferred revenue. This is one of my favorite things to look at. And deferred revenue, what I consider is pretty much a fake liability. So deferred revenue is when a company, for example, has a subscription service. And my perfect example is Netflix. You know, in Netflix, you pay for a full year of Netflix, but it's only the 9th month of your subscription. So you've paid for a full year, but Netflix has only given you 9 months of service. The other 3 months that they owe you is considered deferred revenue because it's kind of considered a liability, because at the end of the day, if they close down shop, it is possible that they might have to refund you back for them not being able to provide you with that service. So that's why it's considered deferred revenue. But usually at the companies I look at, deferred revenue is a fake liability. And I actually like seeing an increase of deferred revenue because it means a lot more people are joining into their subscription services. So seeing a growth there is pretty cool. Commercial paper and repurchase agreements. It's just any commercial paper agreements thing. Again, very self-explanatory there. So that gives you, and then they have term debt. Debt is any loans that they might have within the next 12 months. Now, if we take a look at non-current liabilities, you have term debt, which is just your loans that are due more than 12 months from now. And I do believe it's important. Just because a company has more debt than cash does not mean it's a bad thing, right? Just if a company ever has more long-term more debt than cash, it just gives me a reason to take a look at that debt, because then that term debt, you can look in you can look in the company's 10Q report. So here, usually you can just put senior on the 10Q report and you can get that information. So here you have their term debt, and that's another thing. You can, whatever they used on their balance sheet, just put that on the Control F and they'll take you to where, and you can understand more about it. But look, they have debt that's not due till 2040, some debt that they don't have due till 2049. They have debt due 2025 to 2031 with very low interest rates. Another one due 2023 to 2050. It's insane how far it is. So if it's due within 5 or more years or further back, to me, it tells me it's not a big deal, because it's not really going to affect the cash right now, right? Because imagine someone having a perfect example, your financial statement. Let's say you might have $20,000 in the in the bank, right? But you might have a 30-year mortgage that's $300,000, right? So if you look at it like that, it looks pretty bad if you take a look at just $20,000 of cash and $300,000 of debt. And that might look bad if you look at it that way. But then if you see, wait, it's $300,000 due in 30 years, now you understand, oh, okay, it's not that bad of a thing. But if you have $300,000 due in the next 2 years and you only have $20,000 in cash, then there's some red flags thrown out there. So now that we understand what those are, what I take a look at. Like I mentioned, I'm very focused on that cash and cash equivalents and marketable securities. And I'm also very focused on that debt and loans that they owe and loans that they own. I am extremely strict if a company is not making money right now. For example, if we took a look at the stages, if it's in the growth stage and it's not making money right now, I want to really make sure that this company has a lot more cash than it has debt. And if it does not, that debt better be due very far away. If a company is in post maturity, then I'll be a lot more lenient, because this means this company has been running its business for a long time. They have money coming in. So for me, it's okay for them to have a lot more debt than they do have cash, because they have that current flow of income coming in. So that's pretty much it. That's all I look at when I'm looking at a balance sheet. So that's it for today's episode. Like I mentioned, I hope it provided you value. If you guys want me to do one on the income statement, on the cash flow, make sure to let me know on the comments below. Take care, guys. Have a good night and see you next time.